All right, let's get started. Good afternoon, everybody. Thank you for joining us for lunch today. I'm Kristen Jacoby, and I'm the president of the United Way of Greater Waterbury. So excited to have this conversation, such an important conversation. And as you saw in the registration, and really the purpose for today's Lunch and Learn is to demystify the one big beautiful bill and explore the impact on charitable giving. It's just so important to understand what this bill will do, how it will affect our individual donors, but also our corporate partners. And so I know personally really looking forward to gaining a better understanding of all the implications and even like getting a better idea of practical strategies, like how do we adapt our fundraising and development approaches based on the information that we're learning today. A couple of housekeeping items. First and foremost, today's session is being recorded, so it will be available with materials post this event. And also because there's so much content, we are not going to, in limited time, that we're not going to offer a Q&A session, but we do have, and you'll see it on the screen, we have an email for you to email us any questions that you have. It's unitedway@unitedwaygw.org. That will pop up again so you have it. Please make sure your contact information is in that email, once again, and so we can work with our presenters here today to get your answers to your questions. Very excited about our partners that are joining us to do this presentation. They're such extraordinary experts in this field. They are from Clifton, Larson, Allen, and we also call them CLA, which many of you probably know them as. But really, a really important partner for our United Way. They are a national professional firm that offers audit, tax consulting, wealth advisory, and then other kind of outsourcing solutions. So they make a great partner and they help amplify the expertise you already have in-house. But in this really compliant, important, complicated world, it's really important to have that strong financial background. CLA is very strong presence in Connecticut, though they are national. And once again, they have that local expertise, once again, to help us in that way. Though they do all sorts of businesses, nonprofit is one of their areas of interest and one of their deeply expertise in that area. Really, once again, to the team there, appreciate your support and appreciate your guidance on this important topic. So our speakers today are Rob Capilucci from CLA, Client Accounting Advisory Services. He's the office lead. And then Robbie Williams, the tax principal in the nonprofit sector. So I'm going to turn this over to them in a second. At the end, you'll also hear from Glenn McCabe, our Vice President of Marketing Communications here at our United Way. But let's get right to the topic and turn it on over to the experts. Rob?
Yeah, Kristen, thank you very much. Appreciate that introduction. And thank you for inviting both Robbie and I and CLA to participate in this Lunch and Learn opportunity. Good afternoon to all the attendees on the webinar. Looks like we're up to close to 50. On behalf of obviously the United Way for sponsoring this and CLA, I just want to welcome you and thank you for taking some time today to join us for this learning session. I'm sure you're busy and have many priorities, but the fact that we have this many on the line tells me that this is an important topic. So as Kristen said, my name is Rob Capilucci. I'm a principal with CLA, and I also lead our what we call our Connecticut Client Accounting and Advisory Service practice. That's a lot of words to describe our outsourced accounting practice. We have a way of the way we like to call out that service line, but it is outsourced accounting. And I work out of our West Hartford office. I have the pleasure of leading our work with Kristen and her organization, where we're providing outsourced CFO services to the United Way, supporting Kristen and her internal finance team. Joining me from CLA is Robbie Williams. Robbie's a colleague of mine out of our Arlington, Virginia office. And Robbie, if you'd take a moment to give a brief background on yourself, it'd be great.
Sure. Thanks, Rob, and thanks to Kristen and the team at United Way GW for having us speak today. As Rob mentioned, my name is Robbie Williams. I'm a tax principal here at CLA in our national exempt tax practice. I serve as our firm's nonprofit industry tax leader as well. So I am out of the CLA's Washington, D.C. office. We call it Arlington, Virginia. But I do have the pleasure of serving the United Way of the Greater National Capital Region here in DC too. So it's a pleasure to be here today with you all, and thanks for the opportunity.
Thanks, Robbie. So Kristen explained CLA, Clifton Larson Allen, but you may be asking yourself, who are they? And we in Connecticut, we find ourselves being the best kept secret in Connecticut. So some of you may recognize the name Bloom Shapiro. That's the legacy firm that merged into CLA in January of 2021. But we're basically a professional services organization that offers, as Kristen said, we offer assurance, tax, digital, wealth advisory, and outsourcing solutions. One of the things that I think both Robbie and I are proud of, since our industry specialization is nonprofit, we have one of the largest nonprofit practices in the country and have experience servicing a wide variety of organizations, including social service organizations, foundations, association, membership organizations, arts and cultural, independent schools, and religious organizations. So we run and service the entire gamut of nonprofit organizations. We have approximately 9,000 on our team firm wide. We're spread out across 130 offices throughout the country. We have the great fortune of having a very deep and talented bench of nonprofit consultants to help our clients. And we believe that leading a successful nonprofit really goes beyond just financial reporting and regulatory compliance. And by leveraging broad experience, like a firm like CLA, we can help develop strategies to support mission, strengthen communications with staff and board, and enhance overall organizational execution. So I'll sum it up by saying thank you for allowing me to share a little about CLA. And Robbie, if you're ready to take us through the latest on OB3A, that'd be great.
Great. Thanks, Rob. So we are going to focus today on going over some of the changes to the charitable deductions for 2026 as a result of the One Big Beautiful Bill. As Kristen mentioned, that's how she says it, but you'll hear us interchangeably say OBBA or OB3A, as Rob mentioned as well. So we want to just make sure we're communicating these changes and how they can impact nonprofit organizations like the United Way. So OBBA was passed on July 4th, 2025, and it was the biggest change of tax legislation since the Tax Cuts and Jobs Act in 2017. And I think it's also prudent just to say that there were a couple provisions that would impact nonprofit organizations that did not make the final bill of OBBA. So you can see here, if you all were in the nonprofit sector a couple years ago, the dreaded parking tax, where the transportation fringe benefits were being picked up as a UBI, unrelated business income, that was struck. Some considerations on research income, expedited status revocation, and private foundation excise taxes were also removed. The foundation excise tax is interesting because a lot of nonprofit organizations receive funding from private foundations. So if private foundations would have received a bigger excise tax, that could have indirectly impacted how much they could have given to the sector. So moving on, we're going to go through the individual donor changes first. Here, the first is to discuss the items that are changes to individual charitable deductions for non-itemizers, which essentially, in other words, is donors who take the standard deduction. So this will be effective during 2026 tax year. So for your tax returns that are going to be filed in 2027. This is, again, brand new legislation with respect to this new $1,000 above the line charitable deduction. But if you recall, during the COVID times, there was a $300 universal charitable deduction allowed under the CARES Act back in 2021. So it's very similar in concept, but the amounts, as you can see, went from $300 to $1,000 for single taxpayers and $2,000 for married filing jointly. This is huge. I think because this is 90% of U.S. households fall into this category of taking the standard deduction. So this is from an organizational perspective, a new broader donor base available to nonprofit organizations. And this can be a great way for organizations to work with first time and maybe smaller donors that can now make donations that directly reduce their taxable income, and they can really give back to the community in ways that they haven't in the past. So an individual can take this deduction even if they are still taking the standard deduction. You can't double dip on the same charitable deduction. So if you are making qualifying charitable distributions through an IRA on a tax-free basis, you won't be able to take those same deductions twice. But again, I think nonprofits could really attract and find new donors that may have not donated in the past because they've always taken that standard deduction. So donors who itemize those charitable or itemize their deductions on their tax return, there are a couple changes there as well. So starting in 2026 for tax returns filed in 2027, OB3A provides a floor of 0.5% on a taxpayer's contribution base, which is essentially your AGI, your adjusted gross income. And what does that mean? I'm going to slowly walk through an example so you can kind of have a visual, have an example, and then I'm going to do a visual on the next slide. So this floor works so that if you have an individual has, AGI of $100,000, the individual would be permitted to claim a charitable deduction for only gifts that are over $500, which is at 0.5% of 100,000. So if you had charitable contributions of $300 during the year, the individual would not be able to claim that charitable deduction because it's under that 0.5% floor. But say that it was $1,200, the deduction would be reduced by that floor of $500, allowing a deduction of $700. Additionally, one other item to note for individuals are the new limits to deductions for itemizers in the top tax bracket. So this is that effective rate here, the 37%. And essentially that just caps the tax benefits of itemized charitable deductions for those taxpayers in that marginal tax bracket. So they will not be able to deduct 37%, they'll be capped at 35%. One idea with respect to just taking this to your donor base is looking at what we consider bunching, and that is where nonprofit organizations can really work with your donors to see whether it makes sense to accelerate contributions in 2025 before this floor comes into effect during 2026. So that's what we call bunching. I'm going to go through a visual example of what that might look like now. So lots of numbers here, but just want to go through it kind of from left to right. So option one is the status quo. So this is going to say that in 2025, this is before OB3A goes into effect. And what that means is that the charitable contribution, if you had adjusted gross income of $500,000, your charitable contribution would be $50,000, and you wouldn't have any percent type of floor that would come into play. And then you would have your tax here. One thing to just note is that once the 2026 and 2027 come into play, there is a floor that comes in which is ultimately going to reduce the itemized deductions that this individual taxpayer can claim, which will ultimately end up for a higher tax on their end. On the flip side, bunching is, say, for example, instead of laying those three donations out of $50,000, bunching it into just the 2025 tax year before OB3A comes into play, you'll see that it dramatically reduces the tax rate with respect to your potential tax for 2025. And then it kind of stays the same. Well, it increases from 2026 and 2027 since you're not taking those deductions. But what it really does, because this major reduction in tax for the current year, you would have a tax savings, or the donor would have a tax savings of approximately $47,000 if they do decide to bunch that deduction for that 2025 year. Also, it's just wanted to add that it is a benefit to the charity in some aspects if you think about it. Say, for example, you as a charity are receiving $150,000 for that first year rather than over the 3 years. You could invest that with a 5% return. And that would ultimately, be another benefit to the charity with respect to the different options where you would maybe see a little bit of investment income on that return from bunching those deductions. So something to consider with respect to your donor base and talking to them and communicating them with, how they see their charitable giving. So another way of charitable giving is what we call DAF. So for anyone who doesn't know, DAF is a donor advised fund, and is another way for individuals, families who can carry on charitable giving through different types of avenues. So go through these columns and just kind of go through what this means. So key advantages of a DAF are there are tax benefits. There's immediate tax benefits because you are creating a donor advised fund at an organization that holds those. So there is a tax benefit immediately. There is flexibility because when you open a donor advised fund, it will give you the ability to say how you would like your charitable money to be spent. Legacy, as I mentioned, where families can carry on this tradition of philanthropic giving. Families can be involved in donor advised funds. So it is a way to carry on your legacy without, maybe potentially, opening up your own charity. Limitations. The biggest one here that I just want to touch on is limited control. So when you donate donate charitable money to a donor advised fund, you do get that tax benefit of an immediate tax deduction, but you do lose control over the investments and the grants that are given out of your donor advised fund. That doesn't mean that you won't have any say. A lot of donor advised funds do, sponsoring organizations that hold the donor advised funds, they do give the monies to the organizations that the donor advised fund wishes to give. But from a legal perspective, they do lose that control once it's provided to the sponsoring organization. Another idea or avenue of giving is a private foundation. So many other individuals or families do create private foundations. But one thing to consider is that donor advised fund is set up through another organization. So for example, Fidelity Charitable Funds. So it's a little less expensive and it's easier to manage because it's not the same as operating your own, nonprofit organization. There is less legal restrictions. There's a lot of legal and excise taxes when it comes to a private foundation. So that is something to consider. But again, you do lose that control over where the grants are going with respect to a donor advised fund, from a legal perspective. Ideal donors for a DAF are high net worth individuals, as I mentioned. So looking for those significant tax benefits, especially at the time of the donation. As well as there is on the a transfer of appreciated securities where you can essentially reduce capital gains much easier in a donor advised fund than through a private foundation. So also, again, private foundations are pretty operational. So from a DAF perspective, there's a lot less involvement if need be. So it's a little bit suitable if you want to be philanthropic, you want to do grant making, but you might not want to have that direct involvement or day-to-day involvement. So impacts of DAFs for chapters. So I'm just going to read this. Potential challenges. As I mentioned, when it comes to a DAF, it's not just the DAF. You have the DAF sponsoring organization as well as a sponsor. So the donor, which is the individual or the family that creates the DAF, advises on those distributions, but again, doesn't technically control them. So they can recommend to give to United Way, for example, and it's very rare that they do not follow the donor's intent, but it is something to just note that they don't technically control those funds. They are being given to the nonprofit organizations through the DAF sponsor. Potential opportunities, as this is mentioning, targeted work with engaged DAF sponsors to encourage more DAFs to contribute to your chapter. So, if you do have donors that have donor advised funds set up, just engaging them and making sure that they are communicating with their DAF sponsors and their sponsoring organizations to contribute to the United Way chapters. And again, donors to donor advised funds will receive the same tax savings as giving to a public charity. And it's an opportunity to approach, giving and investing for providing funds to your chapters in a different way. So this is more of the accounting side. So just full disclosure, I'm a tax accountant, so this is a little bit more on the accounting side. But DAFs are not pledges for accounting purposes. So what that means is that if a donor who makes a pledge indicates that they will pay via their DAF, it's not considered a pledge for GAAP purposes. It's just considered an intent to give, but revenue is not recorded for purposes of GAAP until the payment is received. So What that means in terms of best practices is that any DAF contributions received by an organization such as a United Way chapter is to track, because again, there's the donor, the donor advised fund, as well as the sponsor. So if they're giving money to United Way through the donor advised fund to United Way chapter, you might want to track, or it's best practice to track the donor, which would be the associated donor, the hard credit, which would be the donor advised fund, sponsoring organization, and just differentiate that, because you will want to make sure, because on an IRS perspective and the 990 side, it's the DAF sponsoring organization that's being shown as the donor on the 990 Schedule B. So just making sure that when the money is coming in, it's coming in from that donor advised fund and not necessarily directly from the donor. Going to go through some changes now about corporate contributions and deduction changes. So similar to the 0.5% floor for corporate charitable contributions, OB3A did introduce this 1% floor. It only allows a deduction to the extent that there are contributions that exceed 1% of the corporation's taxable income. So what does that mean? Here's an example. A corporation with taxable income of $1 million, that 1% floor would be $10,000, meaning that they would only be able to deduct a charitable contribution on their corporate tax return that exceeds that $10,000. So the deductible amount remains capped, excuse me, at 10%. So that's how it's written in the code currently. So what that means that it has to exceed 100,000, but it would be capped at that 10,000, that 100,000. And any contributions below the threshold, so anything below that 10,000 can be carried forward for up to 5 years. But again, it will always have to meet that 1% floor in order for those corporate, corporations to be able to, deduct that on their tax return. So just note here, there's some risk that companies that were previously motivated by tax benefits. So, working with your corporate sponsors on knowing that these are charitable contributions that they could take as deductions on their tax return, that they might, scale back on some of these routine donations. So it's just something to consider, is just reaching out to any corporate partners that you have, and maybe acknowledging that you understand, or that, there's some new provisions through OB3A that might limit some planned gifts or multi-year pledges, and just work with them and understand, how you might be able to partner with those organizations and find ways to work with them outside of maybe those normal grant agreements that can still benefit both parties. So what does that mean? So charitable giving and sponsorship considerations, corporate sponsorship arrangements are still a viable option because it provides charity with funding and provides positive business exposure. But one thing to note is that there's a difference between corporate sponsorships and charitable contributions. So, sometimes if the sponsorship is set up correctly, it can be considered a business expense under Section 162. And what that means is that it would actually be a full deduction to that corporation, rather than being limited not only to the current 10% ceiling, but also to that 1% floor going forward. So something to possibly consider is relooking at the way that your corporate sponsorships are set up in terms of how it benefits both parties. But one thing to just consider also, as always, is with a nonprofit organization, is how unrelated business income works. Typically, sometimes when you do restructure some of these different types of sponsorship arrangements, there could be advertising, and advertising is typically always considered unrelated business income. And unrelated business income is okay, but it is taxed at a 20% income tax rate. So just understanding that, even though there are new potential benefits and different ways to explore partnerships with some of your corporate donors, working with your accountants to make sure you understand some of that exposure before you get into any agreements. So I'm going to go through some other relevant OB3A changes, just through some that might not affect charitable giving, but also might indirectly impact some of the nonprofit organizations and how they operate. there is a new overtime tax deduction. So beginning with the 2025 tax year, and that's this year. So most of the other changes through OB3A were beginning with 2026, is that the overtime tax deduction does allow a taxable deduction to your income of up to $12,500 on premiums overtime pay. And what that means is that if an employee is paid $15 an hour and gets a time and a half, which is typically no overtime, that time and a half is $7.50. That is the only amount that could be subject to that deduction of $12,000 against your taxable income. So it's not a full deduction of that income. It's just the amount that's considered premium, which is that above and beyond what the normal amount of that regular rate is. And this is just to consider something as, when this is a tax advantage to potential employees as well as any donors to consider or communicate to them as to how they might be able to get different tax deductions, which could ultimately bring different ways that they can contribute to the chapters. So the way that tax deduction works, it is through their paycheck. So, there's no work on a nonprofit or, a corporation's end. It's still, it still has to pay Social Security, payroll tax and everything. So it is just a deduction that's applied to their 1040 individual return. So it impacts their overall tax liability, increases their refund, but essentially it really doesn't impact the organization that's providing overtime. Another thing that might be good for nonprofit organizations is starting in 2026, tax year 2026, Form 1099. So all the 1099s that are required to be filed, there's a change. So the threshold that is currently in place right now is $600, and that threshold is changing to $2,000. So any transactions that require payments of goods or services that typically require a 1099, those are going to now, the threshold for having to file those is going to change. And I think this is going to be a great way for a lot of smaller organizations or mid organizations that typically had a lot of tax filing obligations under these 1099s. That's going to significantly reduce some of that compliance requirements from an IRS perspective. And just as mentioned, for 1099s that are going to be due in a couple months, they still are going to have to file that 600 threshold. So this is going to be for tax year 2026. So green energy credits, that's another thing that was something that is for the first time in the past couple of years available to tax exempt organizations. So a quick background, again, if you aren't aware, the Inflation Reduction Act created and modified a number of renewable credit energy credits, as well as financing programs that were available to tax exempt entities. And as I mentioned, it's the first time that tax exempt organizations could essentially get tax refunds via a tax credit that they can take on a tax return for investing in certain green energy projects. One thing to note here also is that the OB3A, in connection with the Inflation Reduction Act, has made a couple changes to that. So most of the changes are going to be repealing some of these credits that are going to be available starting in 2026. Just something to consider though, because right now they are still in effect. So if you have any assets that qualify under these green energy credits, which is typically solar fleet vehicles, solar panels, these assets have to be placed in service after 1/1/2023. So right now, as the current law stands with OB3A, these will be kind of sunning down in 2026. So you still have some time if you want to place these types of tax credits in service or these types of solar projects in service, that they can still be taken. So as I mentioned, the construction dates are important, making sure that it is placed in service on a certain time, and then based on the tax credits, that'll impact when the tax credit can be claimed on your tax return. As I mentioned, executive orders that are issued through our OB3A might change the governing rules for some of these credits. just a high level here, as I mentioned, these are some that might be a little bit more applicable, commercial clean vehicles. And some of these credits also are credits that can be received by a nonprofit organization, but then can be passed on to for-profit corporations. So sometimes there are incentives to work with organizations knowing that you can claim some of these tax green energy credits and that they can get the benefit. So it's almost kind of like a way to strategize and use that as a planning way to work out some of these agreements. So there's also some changes to the Medicaid and SNAP. OB3A included some major changes to Medicaid and SNAP, particularly affecting SNAP. And what that means is they're changing the eligibility, or OB3A is changing the eligibility requirements for individuals to qualify for those SNAP benefits. There's been some funding reductions as well as some state cost sharings, which essentially means the state's going to be paying a little bit more than they had in the past. So these have been changes as a part of a broader effort to reduce federal funding. But essentially, we're expecting to see an impact on the availability and cost of SNAP programs and benefits for many low income Americans. So with that, I'm going to go ahead. I know that as part of our materials, we also have a one-pager. So I'm not going to go through all of this in great detail, but I think just something to kind of consider is that this is a one-pager that you can provide to any friends, families, colleagues that might want to see how some of these changes from OB3A might impact charitable giving in the nonprofit sector. So this is kind of set up in a way where there's, before OB3A and then after OB3A. So as I mentioned before, those taxpayers who do not itemize, there are ways that, it was previously you had the ability to, you did not have the ability to claim a charitable deduction, and now you do. So a lot of this is just kind of going through, as I mentioned already, the slides that I had previously, but I wanted to maybe go through a little bit more of a robust example from the one I had, just because I think we have a little bit more time on our hands so we can kind of go through this. So again, in the same kind of facet, where's option 1 and option 2, where status quo is essentially where we are staying the same, where you are understanding the fact that any charitable giving over the next 3 years is going to be change for OB3A starting with 2026 and 2027. So what that means is this charitable floor comes into place, and then there's also a cap on your itemized deductions as well. So again, the total deductions allowed here will be $100,000, and then it'll essentially reduce by $10,000 for the years going forward due to the fact that there's that cap. So moving down, again, taxable income will increase, as well as your potential tax to that as well. Going to the right, adjusted gross income here, same as the option 1, but again, bunching here for $300,000, significantly reducing your amount for your taxable income for 2025. As well as, kind of keeping it the same, since you're not taking any charitable deductions, your taxable income will be the same as your AGI in this example. So in this example, numbers are a little bit bigger, but you can still see that there is impact to change the potential tax savings for that donor. In this example, though, just because of the AGI and the charitable contributions are a little bit bigger, there's a much bigger benefit to the charity with respect to being able to have some of those charitable contributions sitting in an investment account or a money market where you're getting an investment return of 5%. So again, it looks like using a 5% return example, that will show an additional benefit of approximately $15,000 to the charity as well. So kind of a win-win for both organizations. Rob, do you think there's anything that I want to go through a little bit into more detail? I don't know if I might have went through something a little too fast or something that might want to be talked through in a little bit more detail.
No, I think you covered it all, Robbie, at a great pace.
Okay. I think for that, then, I think that concludes where we have our materials. The one thing I will say is that if I know that we're not having any Q&A, but if you do have any questions for us, in terms of CLA, we'll be more than happy to help you all. Our contact information for myself and Rob is listed here. But also, if you have any questions, please submit them to United Way at unitedwaygw.org, and then we'll coordinate and collaborate with them to get in touch with you and answer any lingering questions or how these changes to OB3A might impact your organization going forward. Because there's only a couple more months, 2 more months in the year, and there's some potential additional tax savings that can be taken for some of your donors by year end. So having some of those conversations now, seeing if there's any opportunities for them to collaborate with you all and see it from a win-win perspective might be a great idea to connect with your individual base as well as your corporate base, because again, the corporate base might also have a couple changes that might be good to just be a little bit more proactive and discuss it with them from a proactive perspective, because they might not necessarily know how their charitable giving might be affected. And there are opportunities to change the way things are and have it be done where you both, again, it looks like a win-win situation for both. So we thank you for the time and the opportunity to present this with you all today. And thank you for the time.
All right, thank you, Rob and CLA. I appreciate it. I found that fascinating, and I'm a marketing communications guy. If I found it fascinating, I think people who are into this will appreciate what you shared. Some really key takeaways in there. I didn't realize that 90% of the people take that the standard deduction, and that opens up a bunch of opportunities with that. The $1,000 which is our base leadership giving level here at United Way of Greater Waterbury. And then the also handle a lot of corporate sponsorship here, so that shift on where people can move things. So I'm already thinking about some of the information that you shared on that. So appreciate that. As we said, if you have any questions, email them to unitedway at unitedwaygw.org. Make sure you put your information in your email so that we can get back to you with the proper responses on that. And follow our e-newsletter and our social media, because we do have lunch and learns throughout the year. We want you to sign in for and visit us with. Rob, anything to add with closing comments?
No, just again, thanks for participating, and Glenn, appreciate the wrap up, and you have our contact information as needed.
All right, and this recording and the one pager will be on our website shortly for everyone to download and to revisit. So
just one thing I was going to add, Glenn, right? You made a really good point after you thought about that, and I just thought, thinking out loud is, for any employees, potential employees, or through payroll charitable deductions, that 1,000 above a line charitable deduction could be something that even can be explored with employees through those payroll deductions. So another idea of a way to get charitable monies to the organization in a way that they haven't in the past.
Excellent, great point. With that, we'll wrap up. Let people get on with their day and to their lunch, and appreciate everybody joining. And have a great day.
Thanks, everybody.